Welcome to this explainer. Today, we're diving straight into Eli Lilly's latest numbers to crack the real investment mystery behind their absolutely staggering growth. We're going to look way past those shiny headlines and figure out what's literally going on under the hood of one of the world's most valuable companies.
Right out of the gate, Eli Lilly just dropped something most companies can only dream of. 48%. A massive 48% revenue jump in a single quarter. That translates to bringing in nearly $23 billion. For a company of this immense size to grow at that pace, it's basically unheard of in the modern pharmaceutical landscape. And well, with their 2026 revenue forecast now hiked up to an incredible $87 billion, you might be thinking, okay, this is a no-brainer. How high can this go? But there's a hidden number buried deep inside this earnings report that changes absolutely everything about how we should actually view this stock. So let's find it. Chapter 1, The Growth Machine, Mounjaro and Zepbound's Explosive Quarter. So these two blockbuster GLP-1 weight loss drugs, which belong to a class of medications that mimic a natural hormone to regulate appetite and blood sugar, are the undisputed engines of this entire growth machine. Mounjaro revenue just exploded by an incredible 91%, while Zepbound climbed 46%. Together, they generated roughly $14.9 billion in Q2 revenue alone. That is a truly staggering amount of cash flow coming from just two names in their entire portfolio.
Chapter 2, The 60% Number, the Hidden Detail in the Growth.
Okay, here is where things get super interesting. Worldwide volume is up an astronomical 60%, but realized prices are actually down 13%. So what's the catch? Lilly is generating massive revenue growth simply because they're selling dramatically more medicine, despite the fact that they're actually making 13% less for every single unit they sell. When we break that down geographically, the friction gets even more intense. In the US, volume's up 37% with just a tiny 3% dip in price. But look internationally. Volume more than doubled, up 113%, but realized prices took a steep 36% haircut. Basically, they're capturing massive global market share, but they are absolutely sacrificing price to get it done. Which leads us to a crucial question. If Lilly has to sell dramatically more product just to offset these lower realized prices, we really have to ask how this financial model is going to hold up against future rivals. Because let's be real, in the pharma industry, competition always catches up eventually.
Chapter 3, The $14.9 billion Dependency, Concentration Risk.
Mounjaro and Zepbound now make up nearly 65% of Lilly's entire quarterly revenue. Think about that for a second. The remaining 35% is the entire rest of their legacy business combined. What this means is right now, this isn't some perfectly diversified pharmaceutical empire. It's heavily dependent on just one therapeutic category. If the GLP-1 market faces a pricing war or new patent risks, Lilly's overall top line is seriously exposed.
Chapter 4, The Next Lilly, Looking Beyond Today's Blockbusters.
Now, management knows this, so they're betting heavily on what we can call the next Lilly assets. They've got Foundio in the pipeline. That's a super convenient oral GLP-1 pill without the usual annoying food or water restrictions. And then there's retatrutide, their highly anticipated next-gen drug targeting obesity, sleep apnea, and osteoarthritis. And they're planning to file for FDA approval on that in early 2027. And to support this massive future pipeline, they just committed another $4.5 billion to expand their Indiana manufacturing sites. You don't drop $4.5 billion on steel and concrete if you think a trend is just a passing fad, right? This is a huge signal that they believe this market is about to get dramatically larger over the next decade. Chapter 5, The Valuation Puzzle, the $87 billion test.
All right, this is where the psychological shift really happens. A beginner investor sees that 48% revenue growth and immediately thinks, automatic buy. But an experienced investor, they look at that premium and ask, okay, but how much of that spectacular growth is already baked into a $1.12 trillion market cap? Because an extraordinary company can still be a terrible purchase if you buy it at the wrong valuation.
And just to be crystal clear here, you are absolutely not buying this for the income. With an annualized dividend yield of roughly 0.56% at its recent highs, yeah, you're paying a heavy premium today purely for the possibility of extraordinary earnings growth tomorrow.
Chapter 6, The Setup, Perfect versus Imperfect Numbers. It's really a tug of war. For the bull case, you've got the perfect numbers. 48% revenue growth, a massive 85.8% gross margin, raised 2026 guidance, and this booming pipeline. But fighting right against that, you have the imperfect realities of the bear case. We're talking declining global prices, massive revenue concentration risk, and bottom-line earnings temporarily dragged down by a 303 per share one-time charge for acquired R&D, which is basically just money spent buying other companies' research.
So what actually happens moving forward? Well, if the bull case plays out, GLP-1 demand keeps exploding, new drugs dominate, and earnings compound. Great. But what if Lilly remains an incredible company, but growth just slows to the base case, where pricing pressures increase? Or even worse, the bear case? What if competition intensifies, growth normalizes fast, and the market simply stops paying that sky-high premium multiple for the stock?
Chapter 7, The Final Verdict, Breaking Down the Scorecard. This scorecard reveals a pretty nuanced picture. Growth and earnings, screaming buys. Product momentum and pipeline, also incredibly strong. But that pricing friction we talked about, the concentration risk of relying so heavily on just 2 drugs, and that immense $1.12 trillion premium valuation, all of that requires some very careful watching. It is definitely not a blanket buy across the board.
Look, Eli Lilly is undeniably a buy-quality business, but it's not automatically a buy-quality stock for every single type of investor at its current price. If you're a long-term growth investor, it might totally be a buy or accumulate. But if you're a value, short-term, or income investor, the data strongly suggests you should be watching, holding, or just avoiding it entirely for now.
The numbers definitively prove that Eli Lilly is a truly great company. But heading into their next earnings report, this right here is the multi-trillion-dollar question you have got to answer for yourself. Can the next $1 of earnings growth really justify the massive premium price investors are paying today? That is the ultimate takeaway from this explainer, and exactly why you need to keep a very close eye on those volume versus pricing metrics in the quarters to come. Thanks so much for joining me on this deep dive.